So the Biden-Harris administration has reinstated student loans, or have given those who are in the public sector that are able to get their loans forgiven. But now those people that aren't able to do that, like myself, I work part-time, full-time, if you can figure that out. So basically I work per diem, I work part-time, but I work more than actually part-time. So how do you figure out what kind of loans is perfect for you, or should you transfer to a loan holder like a credit union or AAA or somebody, or should you stay with the U.S. Department of Education's loan service? I myself have decided to stay with the U.S. Department of Education. So in this video, we'll figure out what kind of repayment plans that the U.S. Department of Education offers to you. So this is my student loan, so it may be different for yours, but I think you watch the video to the end, you can figure out what will work for you as far as staying with the Department of Education or transfer to a different third-party lender. So here we are. My loan is being serviced by MOA, which is Missouri Higher Education Loan Authority, which is a third party that services all the U.S. student loans, one of many, but kind of goes through. Here's my login site. It talks about return to repayment after the pandemic of COVID-19, and so that's going to return back in September, starting September of this year. First payment will be in October, and it talks about the public service loans, income-driven repayment adjustment, which today we're actually going to dive deeper into, and we're going to figure out how much I need to pay. It may be applicable to you. And then you get the 120 months of public service loan for those of you that are out there to qualify for that. They have that. So the reason I didn't choose to go to another party, let's say your local credit union or AAA membership, for that 25%, they always try to lower you in with the 0.25% interest rate. The reason I didn't go to a third party like AAA or your local credit union, because they try to lower you in with that 0.25% lower interest rate. This is backed by the U.S. government, so I can readjust and change my income-driven loan, which they call, what they used to call the revised pay-as-you-earn or repay, and now it's been changed to SAVE, which is Savings and Valuable Education, SAVE. So those are the different acronyms you may need to know. But here we are. We're going to log into my account, and we'll see you in the next screen here. So in this video, I'm just going to show you an example of how to get a government third-party lender authority to give you a better repayment plan or lower repayment plan without submitting a documentation of income. So it goes by honesty to submit this in, or you can go through the actual U.S. Federal government, federal student loan aid. You can go through them too. But I think for them, they require you to submit some electronic, or even have them, the IRS, submit an electronic form into the U.S. Department of Federal Student Aid. But because I go through Muela, I don't have to do that, where I go through Honesty and I just submit it as is. And here we are. I'm going to log in and put all my credentials in. So for my situation here, you go here. It's an income-driven repayment plan, self-reporting plan through Honesty. So maybe your situation where you're unemployed, or you work full-time, now you're part-time, or you have some medical problems, or maybe you went back to school, went to become a student active military member. So a whole slew of different ways that you can tell the government that, hey, I can't fully pay for what I need to. So I'm going to go keep it simple today. In today's video, we're just going to focus on the income-driven repayment plan. So we're going to click here. And it walks you through. It asks you, number one, the first question is how many children you have, and I have 2. How many other people you take care of. Let's say you take care of your parents, or an elderly person, or somebody else. You would put others here. So I put 2. And how do you file your taxes? So I'm going to file married, filing jointly. And you have, are you married, separated from the spouse? No. can you reasonably access yours? I'm going to just say no, just because you don't need it. And the other thing, the beauty of Moolah is they don't base your ability to pay based on your spouse's income. Obviously, your spouse has her own set of issues. And yes, that is my student loan amount. That's how much I owe, folks. So I wasn't kidding when I almost owe a house there. And then we're going to calculate. I need some information from me. Oh, yeah. So let's say I make 100,000, and it likes decimal. So as you can see here, it says to put it in a decimal form. I say I make 100,000. And I count my zeros. I should be 6 zeros there. Yep. We're going to calculate. Boom. So it says here, if you would use the save repayment plan, it will be 1,500, or you can do the save formula repayment plan, which is a little cheaper, and then it'll set you at 174. So the difference between that and these different plans, the plans get stretched out and the interest rates builds up a little more. So different ways you can do it. But to keep it simple in today's video, we're just going to do the 174. It's much more reasonable and manageable. So we're going to recertify here by clicking here, but we're not going to do that because then we'll have to go through the whole process of applying for it. But in today's video, I just wanted to demonstrate how to do that very easily on Missouri's Higher Education Loan Authority. I appreciate everybody watching these videos. We're almost there, almost to 500 subscribers, up to 1,000 subscribers by the end of the year, hopefully and willing. So keep watching these videos to get these nuggets on personal finance. Today we did it on student loans, so I hope you liked the video, and if you haven't already subscribed to the channel, I'll see you in the next one.